So you'll see, and I have this out on Canvas, this ratio document, so if you lose this handout, you'll have it on Canvas. So the first one is liquidity. So again, I kind of tell you the definition of it because, I don't know, you may see that on the test, you know, what measures the company's ability to turn assets into cash. That's liquidity. So we have several liquidity ratios that we're going to look at. So again, we're really just looking at how quickly we can convert current assets into cash. We talked about liquidity, I think even in college accounting, just very briefly. So again, what that means, all liquidity means is being able to convert current assets into cash. So obviously our checking account / cash is highly liquid because it already is cash. But we're also looking at, you know, like short-term investments that are coming owed to us in the current period would be liquid because we are going to receive that money in the current year. We would also look at like accounts receivable as liquid because hopefully we'll be collecting on the accounts receivable in the current period, okay? Things like that. So we're also, those are the main what we call quick assets, okay? Inventory is also considered liquid, but it's not highly liquid, right? Because inventory, it depends on the industry too, how quickly we're going to be able to buy inventory and then sell it for cash. So inventory is considered liquid, but it's not as highly liquid as like cash, accounts receivable, and short-term investments. So that affects our ratios. Okay. So as you can see, I have all the liquidity measures are on the sheet. We're not going, well, actually, I think we might calculate all of these because they're pretty important. So we're looking at our current position. Current position is going to look at working capital, current ratio, and quick ratio. We're going to look at accounts receivable because that's important. How quickly are we collecting on accounts receivable? And then also inventory. How quickly are we turning inventory over and, you know, getting money for it, cash for it? So these are all liquidity ratios, which are on the sheet. So current position analysis, bless you. These three ratios, working capital, current, and quick ratio, are all easy to compute. They're some of the more easy ratios, and they just help short-term creditors. They give them a picture of how quickly or how easily we can pay off short-term debt. So we're looking at current assets, so cash, accounts receivable, short-term investments, inventory, that sort of thing, and how, if we have enough to cover our short-term debts, okay, or short-term liabilities. Well, working capital is probably the easiest one. You just take current assets minus current liabilities, okay? Now, that's easy except for if it doesn't break it down for you and you have to, you know, figure out which one's current and which one's long-term, but I have faith you guys can do that. So it's truly just taking current assets minus current liabilities to give us the amount of capital or amount of money we would have if we paid off all of our short-term debt with all of our short-term, you know, cash. Okay, so we just truly take current assets minus current liabilities. That one's really easy. Current ratio. Well, here you're just seeing it more as not really a percentage, but just as a different. It's like how many more assets do we have than liabilities? Okay, so current ratio, we just take current assets divided by current liabilities. Sometimes it's also called the working capital ratio because it's the same numbers. You're just doing it as a as a percentage or as a number. Okay. So we would take current assets 550 divided by current liabilities of 210. So these are not expressed as percentages. It's just current ratio 2.6. It means we have 2.6 times more assets than liabilities. So you can see the higher that this ratio is, the more current assets we have to current liabilities is going to be more attractive. If this were a negative number, we're probably not going to get any short-term crediting. So we're looking at greater than 1, and again, it depends on the industry. It's going to change, but we want that to be a positive number because it means we have more current assets than liabilities. So current ratio is just current assets divided by current liabilities. And then the quick ratio, all that means, and I have this listed on your notes, quick assets are ones that can easily be converted to cash. So there we're only talking about like cash/checking, temporary investments, and receivables. So we're leaving out inventories and other prepaid assets like prepaid insurance, prepaid rent that are current assets. Because again, it depends on the industry, but inventory may sit for long periods of time. We may not be able to sell it quickly and get it converted to cash quickly. So this gives, banks or lenders, creditors, an even better idea of our ability to pay back short-term debt. Because if we're like retail, we may have a high amount of inventory, and that's being included in that current ratio. It may not be a good, indicator of our ability to pay off debt. So here we will have to look at the balance sheet and identify just quick assets, which again are cash if we have any temporary investments or short-term investments, and accounts receivable. So we add up our total quick assets, 280,500, divide by our current liabilities of 210, and our quick ratio is 1.3, which isn't bad, because again, that means we have 1.3 times the current assets compared to, or current quick assets compared to current liabilities. So quick ratio, if it's a positive number, we're pretty happy there. Okay. Well, I broke down the practice. You probably see there's a lot on the practice by, just like chunking these up. So let's go ahead and go to the practice. Yeah, keep us working, right? So the third one on your practice is current position analysis. So it doesn't have your working capital, but again, that would just actually be taking your current assets minus your current liabilities. So here they just give us a breakdown. They tell us cash, marketable securities. Marketable securities are short-term investments. So if you see marketable securities, those are a current asset, and they're also used in the quick ratio. Okay. So cash, marketable securities, accounts receivable, inventory, those are all current assets. And then our only current liability is accounts payable. Okay, other current liabilities you may see might be like short-term notes payable or wages payable, interest payable, stuff like that. But in this case, we just have accounts payable. So to calculate the current ratio, again, it's current assets divided by current liabilities. So I would add up all four of my current assets. Okay, cash plus securities plus receivables plus inventory. Okay, and then divide by my current liability of 200,000. Add up all four of those current assets, divide by the 200,000. What is my current ratio? 3. Yeah, good. So if I look at my current ratio, I have 3 times more current assets than current liabilities. Looks pretty good. The quick ratio is going to exclude that inventory. Okay, we don't have any prepaid assets, so the quick ratio, you're going to take cash plus securities plus accounts receivable and then divide by accounts payable. So what is my quick ratio? 2.2, good. So for this company, even when we take out the inventories, we still have a pretty decent quick ratio. So we have the ability of having 2.2 times quick assets compared to current liabilities. So again, on these, it may just be making sure you can identify current assets and current liabilities. Okay, if they give you the whole balance sheet, it's a little bit more difficult, right? So make sure you understand that breakdown. Any questions on that one? And again, you have those formulas on your formula sheet. You can use this on the homework, you can use it on the test, and you can use it on your project. So.
Is this the only thing we can get for the test?
No, we'll talk about Thursday, but I'm okay with more notes. Yeah. We're to that point in the year, right? We all need all the notes we can get. So. Okay, so those are current position ratios. We're still in liquidity ratios, but now we're looking at accounts receivable analysis. So as we know, we talked about in chapter, like 9, 8, our customers don't always pay, and they don't always pay on time. So this just gives us an idea of, are we actually doing a pretty good job collecting on what our customers owe us? So this is an important analysis, more for us too, but also for our creditors, because if we're not collecting on the money owed to us, it really doesn't help us, to generate the quick assets, okay? So we're going to look at accounts receivable turnover, as well as number of days sales in receivables. Okay. So when we look at accounts receivable turnover, we're just going to take sales divided by average accounts receivable. When you see average accounts receivable, we need to take last year's accounts receivable plus this year's accounts receivable and divide by 2 to get average accounts receivable. That's kind of one thing that trips students up a little bit. I put it on your, I did not put it on your notes. Just kidding. I put some other averages on there. But yes, before we can calculate accounts receivable turnover, I think on our practice we're given it as average accounts receivable. But if they don't give you the average, you just take last year's plus this year's accounts receivable, add them together, divide by 2. Okay, so we have to get an average. So for example here, accounts receivable, they told us at the beginning of the year, which was the same as ending last year, is 120,000, and at the end of the year is 115. So we added those two together to 35 and divided by 2 to get an average accounts receivable. So last year plus this year, total is 235 divided by 2. So our average accounts receivable is 117,500. Well, to get our accounts receivable turnover, we would take sales, 1,498,000, divided by average accounts receivable. So accounts receivable turnover is 12.7 times. Okay. So there, the higher the number, the better. The more times we're able, to turn over accounts receivable, that means we're collecting faster. Okay. So we would look at that. And then we would also look at what we call the number of days sales in receivables. So we'll take that same average accounts receivable that we just calculated, and we're going to divide by average daily sales. Well, I gave you this on your notes. I didn't give you that. The average daily sales is sales divided by 365 days. So we're just getting our average daily sales. So average accounts receivable divided by average daily sales. What this means for 2016, the number of days sales and receivables, is that generally accounts receivables sit as receivable or owed to us for an average of 28.6 days. So it takes about 28, almost 29 days to collect. That's down from 39.5 in 2015. This is a ratio we want it to be low, okay? We would also compare this to our invoice terms. If our invoice terms were like net 30, in 2015, we were not collecting within our 30-day window. In 2016, we're barely there, but we're there. So we would compare that. So we want this to be a lower number, okay? We don't want accounts receivable accounts to sit there longer. We want them to sit there a short amount of time, okay? So if our invoice terms were like net 45, we're doing pretty good, or net 60, okay? So we would want to compare that to our terms. Any questions on that one? So again, that's just telling us, are we collecting on accounts receivable in a timely manner, okay? All right, well, let's go back to the practice. Again, some of these little practices make it a little easier than it will be on the homework, but it's the same process, so I wanted to give you an idea of the ratios. So they give us sales, and they went ahead and gave us the average accounts receivable. So we didn't have to calculate that average. And they just want us to calculate the average receivable turnover, as well as the number of days sales in receivables. Well, again, the average receivable turnover is going to be sales divided by average accounts receivables, okay? And the cool thing is, I'm sure you've noticed this in Cengage, when something's in green, you can mouse over it to get a definition. On these ratios, it's kind of nice because it actually tells you the formula for calculating it if you mouse over it. So you have your ratio sheet, but if you don't have it and you're working on the homework, you can mouse over it too. So what's my accounts receivable turnover? 15, good, which is pretty high, so that's not bad. And the number of day sales in receivables, again, here you're going to take your average accounts receivable, that's 210,000, and divide by average daily sales. So you have to calculate average daily sales first. So you would take your sales, 3,150,000, and divide by 365 days, okay, to get your average daily sales, which is what, like 8,630. So then you would take your average accounts receivable of 210,000 divided by the average daily sales of 8,630. So how many number of days do sales sit in receivables?
24.3.
Very good, 24.3. And again, if we were a net 30 invoice terms, that number is okay. We're within our terms. Okay, so we're collecting pretty well. Any questions on those? So I think, again, on those and some of the others, it's just remembering that you have to calculate average accounts receivables if they don't give it to you as an average, and then calculating that average daily sales. So sometimes there's just a couple intermediate calculations. All right. The last liquidity ratios deal with inventory. So again, it's important to look at how quickly we're collecting on sales. It's also important to look at how quickly are we moving inventory out the door. And if we are a retail company and our inventory is sitting in inventory for 100 days, that may not be a good thing. You know, are we purchasing inventory when we already have inventory to sell? You know, how efficiently are we using our inventory and selling it? So we're going to look at kind of the same thing as accounts receivable. Inventory turnover, and then the number of day sales in inventory. So how long is inventory sitting in the warehouse unsold, okay? So it kind of tells us a little bit, well, what happens when we have excess inventory? If we have too much inventory, we're not turning it over quickly enough, well, we're paying cash, or eventually, you know, we're paying for that inventory. So we're spending cash that we may not need to spend right away. Which is also increasing like insurance and storage and some other related costs associated with having too much inventory. And then we're also increasing our risk of loss. If we have inventory that's sitting in inventory too long, we may never be able to sell it, depending on the industry. And then it becomes obsolete or damaged, or, you know, it's just better. We want to keep enough inventory, obviously, to meet customer demands, but we don't want to keep too much. So we do inventory analysis to figure that out. So inventory turnover, we're going to take our cost of goods sold divided by average inventory. So you can imagine, obviously, we're only going to do inventory analysis on like merchandising, manufacturing type industries. If we're service oriented, we don't have inventory, okay? But the companies you chose should have inventory for your group project. So again, cost of goods sold, and then divide by average inventory. So as you can imagine, we need to calculate average inventory if it's not calculated for us. So we would take beginning inventory plus ending inventory, add them together, and divide by 2. And that's kind of what they're showing us here. They give us cost of goods sold. They give us beginning and ending inventory. So we add it up for 547,000. Divided by 2, our average inventory is 273,500. Cost of goods sold divided by average inventory, our inventory turnover is 3.8 times. Number of days sales in inventory, we're going to take that same average inventory, and now we're going to divide it by average daily cost of goods sold. So like average daily sales, but we're taking cost of goods sold, dividing it by 365 to get an average daily cost of goods sold. Okay. A lot of calculations, right? Get tired of numbers. So then it tells us, you know, in 2016, we took our average inventory 273,500 divided by our average daily cost of goods sold, which we calculated. Number of days, sales, and inventory. Inventory sits in the warehouse or wherever in storage for approximately 96 days before it gets sold. That's actually down though. Notice in 2015 it was 132.2 days. That's pretty high. Again, it depends on the industry. Okay. Any questions on those two? All right, well, let's look at those calculations. Oops. So our next practice, obviously, is inventory analysis. So inventory turnover is the one we want to calculate first. So on that, we truly just take cost of goods sold and divide by average inventory. Okay, so cost of goods sold divided by average inventory. Very good, 6. So on these, again, your inventory turnover, although it sounds kind of like a bad thing when we hear turnover, it's actually good to turn over inventory. That means we're moving it. So on average, we move our entire inventory about 6 times a year. Okay, so the higher that number, the better it is. And again, we would want to compare to the industry to really get a good idea if that number is good or bad. Number of days sales and inventory, we're going to take that average inventory of 72,500 and we need to divide it by daily average cost of goods sold. So again, we would have to take cost of goods sold, divide by 365 first. So we take cost of goods sold and divide it by 365, which is 1,192. So we would take average inventory of 72,500 divided by 1,192. So it takes an average of 60.8 days to turn over inventory, okay, or how long inventory sits before it gets sold. And again, that doesn't sound too bad, so we would have to compare it to industry. You know, I would imagine like places like Walmart's and Target's are going to have lower number of days sales and inventory because they are seeing a much more, or grocery stores, you know, they're seeing a very high turnover of inventory, hopefully, on most items, at least perishable items, we hope. We hope. If not, they've got some problems. So that's why, again, we would calculate these and then we would compare to other industry standards to try to see where we're going. Okay, so that wraps up all of our liquidity ratios. Let's see, we have 10 minutes left. I think that's probably a good place to stop. We have just 4 more to cover as far as like the practice goes. So on Thursday, we'll wrap up and cover the solvency and the profitability ratios. There's a little bit less, there's only 3 solvency ratios, so those go pretty quickly. And then profitability. We won't do all the profitability ones though, we'll only do like the first 4. So we'll cover those and then we'll kind of go over what to expect on the next exam. Again, on this one, it's so quick, you know, there's not a lot to really cover. That's why we'll just go ahead and knock it out, get it out of the way. So we will finish the ratios up on Thursday and then review for the exam. So I set your homework and the exam prep due Monday night. So you'll have through Monday night to get chapter 14 all done, so almost a full week. And then we'll test Tuesday morning. And then Thursday will be a project day. Seems like there was another thing I was going to tell you all. I think that's it though. Any questions? Okay. Alrighty.